If an employee becomes disabled or unable to perform his or her work for whatever reason, disability insurance is designed to replace the employee's income at a level that would be comparable to their salary prior to the disability occurring. Disability insurance has traditionally been calculated as 75% of an employee's income. 75% means that employees are not overinsured, which has the added benefit of keeping the disability insurance premium calculated for your company's scheme lower. So for disability insurance, it has been very straightforward, with the replacement ratio of 75% traditionally being seen as a fair valuation for every employee. However, in March 2015, there will be a change in legislation that will affect how disability insurance is taxed. Currently, the disability insurance premium an employee pays is not taxed. Any disability income paid to an employee is treated as taxable income in the same way as if the disabled person is still working. The new legislation changes this. The money an employee pays for disability insurance will be taxed as a fringe benefit, part of his or her overall salary package. In the event of becoming disabled, the income a person then receives will be tax-free. The immediate effect is that each of us will be paying slightly more tax each month, which is not good news. However, it's the consequences of earning tax-free disability income that now needs to be considered. Because disability income will no longer be taxed, some employees will now find that their net disability income increases dramatically and could possibly be even greater as a disabled person than when they were working. So, how would this happen? Have a look at this following example. Please keep in mind that we have simplified this and it is purely illustrative to help clarify the principle. So let's imagine a high-income person earning, say, $700,000. After paying tax, the net income would be approximately $500,000. Disability income would normally be calculated as 75% of the income. In this example, 75% of 700,000 Rand would work out at 525,000 Rand. With the current legislation, this person would still have to pay tax on this amount. This would be less tax than before, as the rate of tax is calculated on 525,000 Rand and not 700,000 Rand. So the net disability income would be at about 400,000 Rand. Okay, keep these figures in mind. Let's look at what happens with the new legislation, which will mean that disability income is tax-free. So, if we remove the tax that was previously payable on disability income, we are left with 525,000 net income. If you compare the before and after situation, this person would be earning 25,000 Rand a year more as a disabled person. As an employee's income band increases, it doesn't take long before many employees receive a higher disability income than when they were working, substantially more at the highest income levels. You could argue that this is simply their good fortune. After all, they would only be receiving this increased income if they had become disabled. You've just seen that the new tax legislation will mean that many disabled people will earn more under the new tax scales than they would have previously. Research has shown that where this is the case, people may not have the level of motivation needed to return to being a productive member of society. Any insurance premium is based on calculating all the possible risks. The potential for people to prolong the period they receive a disability income for is a very real risk that now increases as a result of this tax change. This needs to be taken into account. We think you'll agree that this creates an unfair situation. In a group policy, every employee is contributing the same proportion of his or her salary to the group premium every month. However, it's only the highest earners that will receive a bigger benefit if they become disabled. This could potentially result in increased or prolonged disability claims in this category of earners. As these members claim more and for longer, it will push up the premium being paid by all members. This could be seen as being unequitable for lower earners. So that's why we have developed a new structure that we believe is a fair solution. And the good news is that as a result, we should actually be able to reduce the disability premiums that are paid. From March 1st, 2015, we will offer disability benefits that will be adjusted according to the salary thresholds of employees. To make it all easier to calculate, we've created 3 income bands. For employees earning up to 120,000 Rand per annum, the disability income ratio remains at 75% of salary. Anyone earning up to 480,000 Rand per annum will receive 75% of the first 120,000 Rand, and 60% of income over 120,000 Rand up to 480,000 Rand. For anyone earning over 480,000 Rand, they will receive 75% for the first 120,000 Rand, 60% for income between 120,000 Rand and 480,000 Rand, and 50% for any income above 480,000 Rand. This solution works. Simply continuing with the current scheme beyond 2015 will create unequal levels of disability income net replacement benefits, where higher income employees could potentially earn a higher percentage of pre-disability salary if they become disabled. Lower income employees will not get this benefit. If this happens, it will create a disincentive for higher income earners to empower themselves to become employable again. With this potential change in claimants' behavior, premiums would naturally have to be recalculated, an increase that will affect every employee. By introducing the new disability income thresholds, any disabled employee will earn the same net level of disability income as before the legislative change. This balances out the effect of the new tax legislation, resulting in every disabled person, regardless of income, receiving approximately 75% of the net salary they were earning whilst employed. The additional advantage being that with this new solution, the overall disability risk premium is estimated to drop by more than 10% for a typical employee group. This will go a long way to offset the additional fringe benefit tax that employees will pay on disability premiums from March next year. And that's good news. If you have any questions or would like more information, please contact your financial advisor.